This is our video blog for June 20th, 2011, and after I do this video blog, I'm going to do our regular class. We have a new version out that we've added the S3 R3 pivots to, daily pivots, which also work on the weekly, monthly too, by the way. On extreme days, these are pretty high probability areas to look for counter trend trades, with relatively low risk. Sometimes it goes a little bit beyond it, but if you scale in the way I'll teach today in class, probably 80-90% of the time you'll be able to break even or make money on those trades. Like most days, we really want to buy the strong currencies versus the weak and sell the weakest versus the strong. As you can see today, the yen weekly and monthly trend was up, and it was strong for much of the day, and then it had a weakness for an hour and a half, some strength, and then weakness from that. So, while it was strong, because the longer term trend was up, it made sense to trade that against one of the weaker pairs. You can see that the euro was weak. Let's scroll back to CAD. CAD wasn't really weak. The Australian was quite weak up until about 5. So selling the Australian yen, selling the euro dollar until maybe 4 or 5, both of those would have been a very high probability trades. Coming into today, you can see the euro yen was underneath the hourly, which makes it more likely to go down. And you can simply wait for an hourly moving average resistance area to not get broken. And then once it breaks down, go short, whether you got out with a 5 or 10 pip profit, or one of our other systems is when you see an hour and a half, well, actually the minimum is a half an hour to an hour and a half, 2 hours sideways range. When it breaks down, it's pretty likely, to continue, usually to the lower bands or the next area of support, which was right here. This was the next area, 114. If you got short right here at 29, you had about a 10 or 12 pip risk with a likely 25 to 30 pip profit target. And once it broke underneath this fib area and then came up to a retest, you could have gone short here and here. And we all know that when it's underneath the lower containment band, usually that's where it kind of runs out of steam. It had a nice little bounce right here. Another exact same pattern as this, hour and a half, 2 hour sideways range, and a breakout. Now, if you do a counter trend trade, it's less likely to work, has lower odds, and you should really obey the resistance area. You have a fib area here, hourly moving average, not likely to go above that, and so somewhere in the middle here, I would say, is your profit target, 27. So you had a 23 pip profit target, maybe 10 or 12 pip risk. And the weakness appears to have dissipated. Extreme weakness, and on our currency meter at that time, you can see that the weakness, it wasn't quite as weak as it was before, and so the intensity around 4:30 was less than it was before. And you notice here on the yen, the strength had all but disappeared after 3 o'clock. So doing a euro yen buy was really kind of predicted as of about 3:30. The yen lost its strength, the euro lost its weakness. It's kind of going sideways here between the 200-day moving average and a monthly pivot level. Selling here, buying here, selling here, buying here. It's not breaking out. It's in a very narrow range pattern, and very high probability. The only other trade I would have done on the long side came up here, pulled back, came up again. I might have bought this breakout here, which would have been a loss, and then the second breakout right here is a pretty high probability trade. Usually, because the longer term trend's down, you want to exit those trades at the fib target. So, decent place to get out of the trade and maybe even do a little tiny counter trend trade. The other one, like I said, to look for sells, it was crystal clear. You want to sell the weakest pair. Today it was the Australian yen. And you can see the very similar pattern that we just went over, sideways. The longer it goes sideways, the better. And, I would kind of, if it's making slightly higher lows like that, have this trend line go up a little bit. Why sell all the way down here at 79 when you can get short at maybe 86? 7 extra pips profit. Excuse me. So if you miss that trade on Sunday, or you don't trade on Sunday, it was kind of going sideways again, and a nice, 30 minutes is my personal minimum time frame, but this went sideways a little bit, maybe 40 minutes. Broke down right here. The next area of support is right here. Didn't make much on that trade. It made a lower low here. Usually when currencies make lower lows on the pullback, it's a relatively high probability trade, and then on the way down it just kept going and going. Notice the Fibonacci retracement area. Very high probability end of the move. Especially when these areas are outside of the 2.2 containment bands. Some of the other trades you would have had today, very strong pound. However, the only downside of this, and I would always trade smaller lot sizes when the real-time trend doesn't match the longer-term trend. It's quite weak. This is kind of a counter trend bounce. 330 right here. The weakest one really was the Australian, which also has a longer-term trend that's down too. So, you can somewhat ignore the longer-term trends when they cancel each other out. The real-time trend was strong, weak. You want to buy the pound Australian. Let's bring this up in here. And as you can see, this thing just absolutely took off. And this is what typically happens. This is why I'm sometimes shocked when new traders tell me they're not sure how to make money with our tools. I'm like, I can't make it any easier in this. You buy the strongest pair versus the weakest. You sell the weakest pair versus the strongest. And this is a perfect example of that. Most people don't trade this more than a few times a year, maybe at that. But when you see one currency super strong and another one super weak, you also have a nice little 2-hour sideways pattern right here with a little false breakout right there. I kind of ignore wicks on bars. If it breaks out and comes right back down, I don't care. I don't want to be buying this thing up here at 87. I'm going to buy it right here at 82, get in a little bit early, and you can see it just took off. If you use our new IntelliTrend stop, this is what it's designed for. When you're in these super strong currencies, it tends to keep you in the trade. Look, you're in that breakout, kept you in all the way up here to 53.51. If there's no statistical strength, it tightens the stop. And you can see it's a ridiculously tight stop, especially the farther up it goes. You're in this trade, like I said, around 85 here, 81, in out at 53.51. So it's a 70 pip profit. And it's usually risky to buy above the upper containment band, but if you do get into a trade and anticipating it to flip, right here you might have got out with a loss. If you went back along here, it did flip. Use that as a method of getting out of trades. And up when a currency is up too much, this also makes a phenomenal counter trend trade because usually when they're outside the bands, they reverse. Also, let's put on the 3.0 band, which I haven't updated my studies yet. You go to containment bands. The 3.0 band almost always contains price. This is a new part of how I'm trading and plan on teaching it more in the class. The 3.0 band is a relatively safe area to look for sells. Now, it wasn't quite at that level, but it was only a few pips away. 83, 86. It was 3 pips away. So, and it was at one of our trading zones, likely high. So, especially you had a counter trend signal here. You go short, the IntelliTrend bars are red all the way down. The trailing stop kept you in all the way down. Absolutely huge, massive move down. Now, from 7 to 8, let's look at the currency meter in the pound and the Australian. 7 to 8, this one was actually strong, so there was no real signs of the pound losing its strength. But in the Australian, you can see there was some signs of it losing its weakness. Intense weakness, and around 8:30 or 8 to 8:15 right here, it had significantly less weakness. So one of the two pairs gave very clear signs of a reversal. I always prefer them when both of them do the same thing. But a little bit after 8, you can see 8:05, 8:15, it really didn't have that much weakness. You can see the strength was not nearly as much as before, and it never had off the charts statistical strength on the way up, and very high probability counter trend trade. Swiss, extremely strong one today. I didn't for some reason notice that earlier. You want to trade the super strong Swiss against the weak ones. Super weak euro, very high probability euro Swiss sell earlier. Notice that it was above the hourly here, failed to go above yesterday's or Friday's high. Very low volatility, broke down, and this got you out with a small profit right here. Actually 88, you're short here at 23. Actually, that's not a small profit, 30 pip profit. You short the next pullback right here. It's, sometimes the trailing, I don't wait for the trailing stop to get hit for entry, only use it for exit. Short at 95, and it got you out right here at 31, almost the entire move. Notice how once the statistical weakness disappeared, I yanked down the stop, and it got you out here versus up here. 10 extra pips. That's why I absolutely love the trailing stop. So the Euro Swiss was a high probability one. When the dollar became really weak at 8, the dollar Swiss would have been a good one to sell. Now, this one's just kind of hovering right near the lower containment band. This is a high probability area for profit target, and as is this one. Usually they don't go too far underneath the lower containment band. So coming up to 8 right here, sideways range, you might have sold this breakdown here, and especially when it goes underneath the lower containment band, you would have been out of this trade right here at 28. It wasn't the best trade in the world. Maybe you're short at 48, out at 28, made 20 pips. But pips are pips, especially 20 pips adds up. Earlier today, again, super strong Swiss. The Australian was weak, so you could have sold the Aussie Swiss as well. This one probably fell like a rock as well, as you can see. And another perfect sideways pattern here, especially hour and a half, 2 hour sideways with low volatility, very tiny bars, very high probability. Our currency meter already had you looking for this. The Australian was one of the weakest. The Swiss was one of the strongest. Doesn't take a rocket scientist to sell that. And then you're out of this trade here around 62. So that's 20 something pips. You got a nice little counter trend move up right here with your initial stops right above the high. If it breaks the trailing stop, you use that to get out, which guess what? Got you out almost at the bottom at 01, 89.01. Short this at 61. That's 60 pips. Phenomenal. 20 pips here, 60 pips there, 3 pips here, 15 pips there, occasional 5 to 10 or 12 pip loss. Notice, with using a trailing stop as your exit, if it starts to go your way, your stop tightens, and a lot of times your initial risk, which might be 10, 12, 15 pips, is not what you end up having as a loss, because it usually goes your way when you're trading the strongest and weakest pairs, at least 3 to 5 pips, which tightens your stops 3 to 5 pips, most times. So that's it for our Forex blog.